Hi, everyone. Welcome back to Professional Development for Creative Practices. This is the first of our recorded lectures, and today we're going to be talking about business formation. So just follow along with me. As always, this is all available on my GitHub. It's github.com/Orthelius, ORTHELIOUS /6350_F20/wiki. So also, if you're in my class, you'll have these links, but I'll also post this in the video description. So yeah, let's switch over to the project site. So yeah, today we're going over the concept of business formation. And so why do we need to talk about business formation? Well, in creative practices, at some point you're going to run into the question of what kind of business are you? And this is important for things like getting paid, hiring contractors or employees, how you sign and enforce contracts, paying taxes. You need to have a structure to your business. It provides the scaffolding. It allows you to operate within local, state, and federal law. And it gives you a greater deal of protection, efficiency, and money-making potential. Now, importantly, business structures are about what you are as a business. It's not about what you do. So this is why in this unit, we can talk basically any structure we talk about in this unit you can find in creative practices. So let's just roll right into it. Here are the sections we're going to go over. Hopefully going to keep this under an hour. We're going to talk about status and size. We're going to talk about business structures themselves. We're going to go over unincorporated structures, and then we'll go over incorporation. We'll talk about some other considerations and then wrap up with some additional structures and some resources I've included. So first off, we're going to start with status and operating size. So when we start talking about business structures, it's not one size fit all. You have to find the right fit for your practice. It depends on a variety of factors. Are you in business alone or do you have partners? Do you need to depend on employees, or do you have occasional independent contractors you might work with? What type of fundraising do you need access to, and how can you reduce risk? There's a ton of factors that go into, but we need to kind of start off with some real basic considerations. We're going to start off with the idea of status and operating size. And now, when I talk about status, went too far. When I talk about status, we're talking about things. We're going to cover this more in the representation and labor unit, but what we need to basically understand is the difference between an employee and someone who is self-employed, also known as an independent contractor. Now, I got these definitions from the IRS, so you know they're at least somewhat valid because they're the people that collect our taxes and they're the ones that care about this. So for an employee, the definition is this. So under common law rules, anyone who performs services for you is your employee, if you can control what will be done and how it will be done. That clause, I emphasize that, is very important. If you can control what will be done and how it will be done. And I'll go into an example of this later. So this is so even when you give the employee freedom of action, I've screwed up the reading of that sentence. This is so even when you give the employee freedom of action. What matters is that you have the right to control the details of how the services are performed. Now, we're going to contrast that with someone who is self-employed, or commonly called an independent contractor. You'll also hear this called a freelancer. This is extremely common, incredibly common, and probably the majority of what we're going to talk about in this class is someone who's self-employed. So the general rule is that an individual is an independent contractor if the payer has the right to control or only direct only the result of the work and not what will be done or how it will be done. So the essential differences here are, if you're an employee, everything is controlled by your employer. And if you've had a job in the past or you've been an employee, it's things like they provide the uniform, they provide the location, they provide the materials. They provide everything. They control your rate of pay. They control how often you'll be paid, what your wage is. But they're also responsible. They have to take care of you on the site. When you're on site at the job, they control all aspects of it. Whereas an independent contractor is a little bit different. They can determine what they want to have as the finished product, but they can control how you do the work. And you have to provide your own things. You have to provide your own tools. You have to provide your own employees, et cetera, et cetera. But the point is that it's all about these differences of control. So let's roll into an example. So let's say, for example, you're a costume designer, and I like to use costume designers. Film and theater is just full of every type of example you can think of when it comes to labor, just between like the unions, the variety of jobs and how it changes. And plus it's just a very long, rich, and kind of set history in performing arts around these different ideas. So let's say a costume designer is going to be hired to work on a limited run TV series. They could be hired as an employee of the production company. Now, in this scenario, the designer would be on the company payroll, have their taxes withheld by the company. We'll talk about that later in taxes, and would have access to the company's benefits. So, for example, they could be on the company health insurance. The employer, which is the production company as example, controls all aspects of the employee's work, including location, hours, wages, and providing tools and materials. But let's say that the production company doesn't want to hire an employee, which is really common. I mean, they don't need a costume designer forever. It's a limited run TV series. So they're going to contract the costume designer as an independent contractor. So now the designer is going to be self-employed. Now the designer must invoice the company in order to get paid. They're responsible for what they owe in taxes, and they will not have access to company benefits. There is a great spelling error there. It's compet. Should be company. This does not allow independent contractor. This does allow the independent contractor a certain level of freedom. They can choose the amount of time, rate of pay, etc. The production company can only control the result of the work. So in the latter scenario, picking the right business structure can be key to saving money, limiting your personal liability or risk, and providing some continuity in how your business is run. So this is why your status is very important. You know, are you going to be an LLC or are you going to be a sole proprietorship? Well, I would advise different things based on what you're doing. So first is that idea of employee and self-employed. Second, we're going to talk about operating size. So operating size, in this instance, is referring to how many people are part of your company. Having 50 employees as a sole proprietor can not only be cumbersome and extremely challenging, but it also opens that person up to a large amount of risk. We're going to talk about this later, but a sole proprietor basically means it's all on you. All the risk is on you. So if you have 50 employees, and you can have 50 employees as a sole proprietorship, it can be very cumbersome, it can be very risky. So maybe that's when you want to go more of the route of incorporating under an LLC or something similar, where you can kind of give yourself a cushion, but also take advantage of everything that's available to incorporated structures. Now, in contrast, running a one-person S corporation may bog an individual down in too many bureaucratic responsibilities, outweighing the advantage of this more complex structure. Now, an S corporation is something where you could have 100 different shareholders, but it could be a corporation. It's a larger setup. And in this situation, you want to hire on employees to help you manage this. Like managing the complexity of a corporation with all of the different filing requirements is a little complicated for one person. Not impossible, but complicated. So with each business structure, we need to take a moment to consider operating size. And for this unit, we're going to use some loosely defined sizes. So the first one is the individual. So the individual is what it sounds like. It's a person operating their business entirely on their own. They might also have one or two employees to help them out, but the operation of the business falls solely on them. So think of a fine artist with a burgeoning studio practice, an actor with consistent work on the Broadway scene, or maybe a graphic designer who creates branding for a small business. The idea here is it's one person is primarily in control of the work. You know, it's not every day you're waking up and meeting up with 3 or 4 people that help you run this thing. It's mostly on you. And so for each of these sizes, I chose some alumni examples of people I've worked with. So this example from the School of Art is Claire Henschker. And this is a piece from a series that she used machine learning with Grand Theft Auto to layer these images and kind of create these I'm going to do a bad job of explaining it. You should just go to her website. But Claire is someone who works on her own. She uses her own materials, which is she's primarily a digital artist, or a new media artist, so she's using a laptop in this case. But she's producing these images. She's negotiating with galleries. She's getting the prints made and framed. She's doing interviews. She's handling all this stuff on her own. She does not have a studio manager that helps her out. She does it entirely on her own. So this is a good person to keep in mind. You can go look at her website and think about, like, this is kind of what I mean when I'm talking about an individual. It all really falls on her, and her success hinges on that. So next, let's talk about a small group. So for the small group, let's set that as a business that operates with anywhere from like 3 to 50 people. When you manage a group of this size, you're going to be splitting up roles, and there may be one owner or partner in the business, more than one owner or partner in the business. So think of like an architecture firm working in a mid-sized city. They might have like between 20 and 30 people on staff. A recording studio, they're frequently hired session musicians. Now, those session musicians might not be employees, but you're talking about someone who's running a recording studio dealing with like 10, 15 different musicians coming in and out, working with different artists coming in to record. It's very complex. It really involves the need. It needs more than one person to manage that. Or think about like an artist collective comprised of a changing roster of artists. The point here is that a small group, it really, really needs more than one person involved. And there's different structures that would help you with that. And there's different approaches. Some structures like a partnership might work. Other structures like an LLC might be better. But these are things to consider. So for the small group, for the alumni example, I use Luca Damasco and Zach Rispoli. They created this free open source tool called the Wick Editor. They formed the business themselves. They created the tool themselves. So they had to always work with each other or in the early stages of their company. I believe they operate as an LLC. But throughout the process, they brought on additional designers. They brought on additional people to build out back-end portions of the website. They had these different temporary employees, and they also had different contractors involved back and forth. And then it always went back to the core too when they were first developing this project. So this is an example from an alumni of a successful website that's built. It's a great website. You should check it out. This is an example where it involved more than one person. And for a large group, I forgot to put a description. Oh, well. A large group, this is just more than 50 people. We're talking massive, big corporations. And my alumni example here is Kevin McPhail. He came out of the CMU architecture program. Kevin works at Oculus VR as a researcher. This is actually him in an example image of, they're doing this kind of face tracking and recreating. So it's when you move around inside the visor, you can actually have your face projected out into a virtual environment. And I'm not going to be good at explaining it, but the point is that Kevin works as a researcher, a hardware researcher at Oculus VR. He's not running the business. I mean, it's a huge company. There's a lot of layers to it. He is able to focus entirely on his role of being a hardware engineer because he works in a large group. When you work in a small business, you might have to wear many different hats, but when you work in a large group, you can be pretty focused. So it's like large groups are not always bad. Okay, and now let's go into the next part, which is we're going to talk about business structures. So we've already talked about status and size, and now we're going to get into the different type of business structures. So we're talking about our definition of a business structure, the purpose of a business structure. I have this acronym I use, which is FORCE, to help us understand the key differences. And then some of the structures that we're going to cover in this unit. So I found this from the Farlex Financial Dictionary, which is an interesting name for a financial Farlex. Maybe that's a person. So business structure, it's the way a business is organized. The business structure states who owns the company, how profits are distributed, and which managers perform what jobs. It is also important for tax and liability purposes, as companies are often taxed differently from each other, and managers may have different levels of responsibility in the event of a wrongdoing or a lawsuit. In the United States, the three business structures recognized by the IRS are sole proprietorship, partnership, and corporation. Other structures that are legally important, but not for tax purposes, that's actually inaccurate, includes limited liability company, S corporation, and C corporation. So that's the official definition of a business structure. Our working definition that we're going to use is it's the framework or legal establishment of an entity for conducting business. You can kind of see a peek of the next section. A business structure defines what a business is, but not what the business does. So, for example, you can have a sole proprietorship, which is just you. You can have a partnership, which is you and another person. Or maybe you work in a nonprofit organization, which is a group of people incorporated together. But you could all be producing fine art exhibitions. The difference there is the structure. The difference, they're all doing the same, all those examples are doing the same thing, but the structure is different. And so, like the definition above, a business structure addresses things like who owns the company, how can I raise money, who's in control, and what taxes do I owe. You'll also hear business structures are the term that's used interchangeably with things like business entities, organizational structures, operating models, business licenses, business types. Essentially, those terms are all referring to essentially the same idea, which is this structure, this scaffolding of the business. So we're going to use force to understand these structures. And I use Baby Yoda because, of course, how can you use a acronym like force and not reference Star Wars? But I love Baby Yoda. It's very cute. So as I mentioned, this course is taking the 20,000 foot view. So we don't really have the time or ability to get granular with all of the different structures we need to cover. This is our only unit on business formation, so we gotta kind of roll quickly and kind of go from a very high level. That being said, I tried to break this down into 5 different factors that are easy to understand and also make for a nice little chart. So the different elements of force are financial setup, ownership, risk, control, and establishment. So financial setup. What options are available to the business that bring in money? This could include things like debt financing, fundraising, sales, the sale of equity, services. There's all kinds of different things, but it's like what does the business structure allow the business to do to bring in money? They're very different. But this is something we're also going to cover when we get into income, the idea of different income streams. You have to have certain business structures for certain income streams. And then importantly, what is the financial or tax burden for the company? Ownership, literally, who owns the company? And then what responsibilities do those owners possess? It changes depending on what structure you're talking about. Risk, this is a big one. Whose assets? So when I say assets, those refer to things like property, both physical property, like a car, a house, inventory, things like that, but also things like intellectual property. Whose assets, if any, are at stake? What is being risked? If you go bankrupt, what happens to those assets? Who has to take personal responsibility if a problem arises? This is a huge one. Or I'm going to talk about the word liability a lot. So it's who has to take responsibility. If there's a lawsuit, who is held responsible? And then also with risk is what protections can you put in place? How can you separate yourself from that risk? How can you mitigate it? The next one is control. How are business decisions made? This is different than ownership. You can have ownership in a company, but not have any control. Oh, I'm fuzzy now. See if we can fix this focus. Oh, there we go. A little bit better. Okay. Control. How are business decisions made? Who has functional control of business operations from day to day? And who has overall control of the total company? There are different answers to each of these questions based on the business structure. And then finally, we have establishment, which is what are the minimum legal requirements for forming this business? For instance, sole proprietorship, you can just start. But if you want to have a nonprofit organization, there are a number of specific steps and filings you need to go through. So again, force, financial setup, ownership, risk, control, and establishment. I don't know why I counted that way with my fingers. We're just going to move on. So the structures we're going to cover in this unit are sole proprietorship. So quick definition, sole proprietorship. One individual or married couple, they count as one person, in business alone. Partnership. A general partnership is composed of two or more persons, usually not a married couple, who agree to contribute money, labor, skill to a business. Basically, you're partnering up. It's what it sounds like. And we're going to talk about two different types, a general partnership and a limited general partnership and a limited partnership. We have a limited liability company, also known as an LLC. This is formed by one or more individuals or entities through special written agreement. We have S corporation. An S corporation is also called an S corp. It's a special type of corporation that's designed to avoid this idea of double taxation, which is part of C corps, and none of this will make sense until we actually explain what these two are in depth. So also next we have C corp. Corporation, sometimes called a C corp, is a legal entity that's separate from its owners. C corps different from S corps primarily in their ability to sell common stock. And then finally, we have nonprofit organizations. Nonprofits are organized to do charity, education, religious, literary, or scientific work. If you were taking this class at Carnegie Mellon, you're all currently involved with a nonprofit organization. Okay, next up, we're going to talk about unincorporated structures. So there are three types of business entities that you can operate under in the United States. Broadly, a sole proprietorship, a partnership, and a corporation. We're going to cover corporations in section 4. All corporations require the important step of incorporation. It's a legal process you have to go through. So that's why they're separate from sole proprietorship and partnership. If you have to go through the process of incorporating, you become a corporation. Sole proprietorships and partnerships can be established and operated without the step of informal incorporation. They're kind of the default starting points for many small businesses. And I want to emphasize, I'm going to say this a couple of times, sole proprietorships and partnerships can be incorporated. It's a process you go through to become an incorporated structure. You can be a single person incorporated corporation. So you'll oftentimes hear about like a single person LLC. But let's jump in. We have two unincorporated structures, sole proprietorship and partnership. So let's start out with the sole proprietorship. Get this sized up just right. So what is a sole proprietorship? So sole proprietorship is one individual or married couple in business alone. Sole proprietors are the most common form of business structure. This type of business is simple to form and operate and may enjoy greater flexibility of management, fewer legal controls, and fewer taxes. However, the business owner is personally liable for all debts incurred by the business. They're actually liable for more than just debts. They're also liable for legal challenges, lawsuits, all kinds of stuff. But sole proprietor, this is the default starting point. I literally wrote that. So sole proprietorships are the default starting point. So if you engage in some kind of business, boom, you're automatically a sole proprietorship. You have complete control over your business and the profits, but you also have all the risks and the losses. So, let's say you have a piece of artwork, you have a print that you made, and you go to an art fair and you sell that print to someone. You are now a sole proprietor. It's a default starting point. It's one person in business by themselves. You can just start immediately. So let's look at the force. So financial setup. For sole proprietorship, profits are taxed once. It's all personal income tax. So the idea here is, and we're going to get into this with incorporation, is that it's all joined. Your money is joined together. So profits are taxed once because everything you make is considered personal income. That being said, the profits also entirely belong to the owner, as do the debts. Your ability to raise funds is limited to personal capital, so that means your own money, personal gifts, and loans. Personal loans. That's it for raising money. Can you sell part of the business? Legally, no. Sole proprietorship can only have one owner. If you want to have additional owners, you have to incorporate. That is a restriction of sole proprietorship. So here's the thing. Sole proprietors, all the money is yours. But you're kind of limited in terms of how you can raise money as well. Ownership. Second part of force. Singular owner. You are the boss. There's no legal distinction between the business and the owner. And we'll understand why those two can be separate when we talk about incorporation. And then you cannot transfer ownership because you cannot transfer yourself. If you want to have someone take over the business, you have to sell the entire business to them. You cannot transfer the ownership. So if I have Tom Hughes, just the company Tom Hughes, I cannot transfer Tom Hughes over to someone else. I have to sell the company to them, and then it becomes Bill Withers. I don't know why Bill Withers. He's dead. He's a sole artist. But anyway, Bill Withers' business. If you transfer ownership, that was such a weird example. Okay, let's talk about risk. Sole proprietors mean on the continuum of risk here, sole proprietors carry the largest level of risk because there is no separation between the business and the owner. Your business assets and your personal assets are one and the same. This is a very important thing to remember. If you go bankrupt, for instance, your business goes bankrupt and you're a sole proprietor and the bank comes to collect, they could take things like your car, they could take your house, they could take all the money in your bank account because you know what? It's all joined together. So it's unlimited liability. You alone are responsible if anything happens. So like I gave with the example of the art print, if you're selling a print to someone, that's pretty low risk. It's fine to be a sole proprietor. But like, let's say you're going to do a large scale public artwork that involves tons of welded steel hanging out in a public place and it's kind of precarious and could hurt someone. You might want to be separate from that in a sense. So that if something goes wrong and someone sues you, you have a little bit of that separation. They can sue the business, but your personal assets are protected. When we talk about control, the fourth element of force, singular owner, you're the boss. You control everything. And then establishment. So it's not, there aren't really mandatory requirements to start a sole proprietorship, but there are best practices. You want to have things like a business banking account to help keep your personal and business accounts separate, easier to track. And sometimes you're going to need like an industry specific license or permit, which we'll talk about later in this unit. Okay, next up, let's talk about partnership. I'll leave this GIF here for a second. It's a great GIF. It's from the movie Predator. So partnerships are just what they sound like. It's two or more people sharing the burden, sharing the success, sharing the losses. This is the second easiest business structure to form and provides for a great deal of control, but like sole proprietorships, come with a decent amount of risk. So we're going to cover two types of partnership, general partnerships and limited partnerships. Start out with general partnerships. So a general partnership is composed of two or more persons, usually not a married couple, because remember, a married couple could be considered a sole proprietorship, who agree to contribute money, labor, and skill to a business. Each partner shares the profit, losses, and management of the business, and each partner is personally and equally liable for the debts of the partnership. Formal terms of partnership are usually contained in a written partnership agreement, which we're going to cover things like partnership agreements in the next unit on legal agreements. But the important thing here is this kind of part here. I don't know if I can point there. No, I can't point into there because I disappear. The idea of being equally liable. When you get into business with someone, you're going to share responsibility. Be careful about who you get into business with for this reason. You can have protections put in place through your partnership agreement, but in general, partnerships can be a little hairy. Limited partnership. A limited partnership is composed of one or more general partners and one or more limited partners. The general partners manage the business and share fully in profits and losses. Limited partners share in the profits of the business, but their losses are limited to the extent of their investment. Limited partners are usually not involved in the day-to-day operations of business. So what's an example of this? Let's say that you're starting a gallery. You and your best friend start a gallery, and you're really excited about it. But the thing is, you don't really have a ton of money to get off the ground. So you get into a limited partnership agreement with someone who's going to contribute money to get off the ground, and then they get 5% of all sales. And that's it. That's their partnership. They get a chunk of money, and that's it. That's all you have. They don't get to tell you how to run the business. I mean, they're going to have an opinion. They own 5% of it. But the idea here is that they have limited involvement. You and your best friend, though, that's the main person you're going to have to work with. You just have this little pinky off to the side that helps you out with money. So let's look at force. So first element, financial setup. In a general partnership, profits pass directly to the partners. And again, I keep talking about this idea of passing directly to people. This will make more sense with incorporation and the idea of double tax. So general partnership passes directly to the partners. Each partner is responsible for their own personal taxes. Like sole proprietorships, ability to raise funds is limited to personal capital, personal gifts, and loans. So I want to go back to the idea that each partner is responsible for their own personal taxes. That means that, like, let's say it's just a general partnership, it's 50-50. It's you and your best friend in this gallery. You get $100. They take home 50, you take home 50. You pay taxes on the 50 you took home. They have to pay taxes on their 50 that they took home. So you're responsible for your own personal taxes. Limited partners. Profits are distributed to partners according to a partnership agreement. You need to have a partnership agreement for a limited partner. So again, taxed once. The responsibility corresponds to the level of ownership. So in this example, let's say it's you and the general partner, and then you have the little pinky partner over here who has 5% of sales from your gallery. They're only responsible for 5% of the taxes. You and your partner are responsible for everything else. And there's a little bit of a trick here, and we're going to talk about this later in representation and labor. General partners pay self-employment tax, which is it's a specific tax. Also, sole proprietors pay this as well. I should have mentioned that. Specific tax for general partners, but not for limited partners. They just have to pay it as income tax. Ownership. So for general partnership, it requires 2 or more people to own it. It's a partnership. Ownership is automatically 50-50 unless it's spelled out in a partnership agreement. This is extremely important. If you want to own 90% of your business, put that in the partnership agreement. Otherwise, legally, it's just automatically 50-50. If there's 4 people, it's 25-25, 25-25. And then ownership can transfer to new partners depending on the partnership agreement. This is the thing to be wary of in partnerships, is that let's say it's you and your best friend, and then you and your best friend get into a huge blowout fight, and your best friend's like, whatever, I'm selling my half of the business. And they sell it to someone you hate. But the thing is, now you're stuck in a partnership with them, with this person that you hate, because you didn't tell your best friend that they can't just go and sell to anybody. These are the things you have to be wary of. There are these default things with partnerships. So this is why you want to have a partnership agreement. You don't want to just start working with someone right off the bat. You want to have some level of agreement in place. It reduces risk, which is the next part. But anyway, now for a limited partnership, again, 2 more people, but there are 2 types of partners. General partners, which are the major partners, and limited partners, which are minor. So ownership and transfers are defined by the partnership agreements. You need to have it in writing for a limited partner. Basically, it says you own 5%, you get this, and these are the things that you're allowed to do, but you can't do all these other things. You want to have that in a partnership agreement. Risk. Okay, unlimited personal liability for the partners. The partners are liable for each other's actions. This is the deadliest thing about general partnerships. We're not incorporated yet. We haven't got into incorporation. You can incorporate partnerships to deal with this risk factor. But if you get into a partnership with someone, if you and the best friend in the gallery example, your best friend goes off because they're terrible at managing money and they sign up for a huge business banking credit card, and they run up a debt of $30,000. And you're just like, holy, how are we going to deal with this big debt? Here's the thing. You are also liable for that debt that they drove up. You're liable for each other's actions. Now, there are limits to this, but in general, it's a pretty bad case. These are things that partnership agreements and operating agreements and incorporation will help you with. But it's a good thing to remember with a partnership. When you get into business with someone else, you're liable for each other's actions. So let's talk about the limited partnership with risk. So it's unlimited personal liability for general partners. And I want to back up for a second. When I'm talking about unlimited liability, I mean it's like the sole proprietor example. If something goes wrong, your personal and your business assets are still intermingled. So limited partners, you have limited liability. So a limited partner, the person that owns 5% in my gallery example, they may have limited say in what the business does, but likewise, they have limited risk. Control. The partners are in charge. Control is automatically a 50-50 split unless spelled out in a partnership agreement. Let's say it over and over again, partnership agreements. That's the way that you want to go. There are laws that vary state to state that govern what a partner is able to do on behalf of the partnership. Now, for limited partners, most often the general partners are in charge, but limited partners do have some say in business operations, but it's usually more like expressing opinions. A partnership agreement would spell that out. Again, partnership agreement spells things out. And again, there are laws that vary state to state governing what a general or limited partner can do. So again, control. The partners are in control, but remember that split. It's automatically 50-50, or, if it's 3 people, it's 33, 33, 33. You get the idea. You have to work with someone else unless your partnership says otherwise. You might have a general partnership, and then you might have a partnership agreement that says, okay, there's 4 of us, but I'm the one in charge. I run the business. That could be in a partnership agreement. Okay, let's talk about establishment. So like a sole proprietorship, there's not necessarily mandatory requirements to start. But the absolute best practice is to have a written partnership agreement in place. Make the rules clear. And again, I've already covered this, but when you add a limited partnership, it must be done through a written partnership agreement to outline who is the general partner and who is the limited partner. Okay. Now we're going to head on to the next part. Now we are kind of crossing over into this idea of incorporation. Now remember, sole proprietorships, partnerships, you can incorporate those structures. It's just that those were the default starting points. Those were the unincorporated forms, but we can incorporate them into most of the forms, if not all the forms we're going to talk about now. So it's this idea of incorporation, and we're going to get into everything that means. So we should just jump in. All right, incorporation. So whereas like a sole proprietorship or partnership can be formed instantaneously with a simple agreement, now we're crossing into the world of incorporation. The rest of these business structures we're going to cover have a very specific filing and formation requirement. So what is a corporation? Corporation is a more complex business structure. A corporation has certain rights, privileges, and liabilities beyond those of the individual. Doing business as a corporation may yield tax or financial benefits, but these can be offset by other considerations, such as increased licensing fees, decreased personal control. Corporations may be formed for profit or nonprofit. So this is the big idea. To incorporate is to create a separate entity that can exist independent of the people who originally founded it. So for example, Kentucky Fried Chicken, or I guess they only go by KFC now. What happened after Colonel Sanders died? KFC continues. The idea here is to create a legal separation from yourself. And that is sometimes negative, that's most times positive. Now, what happens when you're separate? It gets into this idea of corporate personhood. So corporate personhood is the legal notion that a corporation, separately from its associated human beings, so the owners, the managers, the employees, has at least some legal rights and responsibilities enjoyed by a natural person. So the simplest example of this, a corporation can sign a contract. So let's say that you have a small company, and one of your employees is the person that signs contracts for working with a construction company, for instance. When they sign that contract with the construction company, they're not signing their name, like, well, they are, but they're not signing like them personally or approving it. They're signing on behalf of your company. And if you fire that person, the contract stays with the company because the company is separate from the people. So that is the idea of incorporation. You are turning it into a thing that can't exist on its own. So it's about creating that layer of separation and protection. So incorporation is a legal process that must be done through a government. Most of the times there is an exception with a nonprofit organization. Most of the time you have to do this through a state government, not the federal government, but a state government. So unlike a sole proprietorship or partnership, you cannot create an incorporation on your own. Articles of incorporation must be filed. Sole proprietorships and partnerships can be incorporated, as I've said. But you can't just, like I was giving the example of like you make a print and you go to an art fair and you sell it, you're automatically a sole proprietor. Great. You want to start your own company, you have to file paperwork and usually a fee with the state government. I think it's like a few $100s to start an LLC, depending. So we're going to talk about 4 incorporated structures. We're talking about a limited liability company, LLC, an S corporation, a C corporation, and I can't bend my finger right, and a nonprofit organization. So let's just jump in. Limited liability company. So this is kind of like we're going from simple to more complex. So what is a limited liability company? A limited liability company is formed by one or more individuals or entities through special written agreement. The agreement details the organization of the LLC, providing provisions for management, assignability of interest, distribution of profits and losses. LLCs are permitted to engage in any lawful for-profit business or activity other than banking or insurance. Why banking or insurance? Because there's tons and tons of regulations around that, but not super important for what we're talking about. So LLC is that first step of incorporation. It's kind of like a lot of people in small business choose the LLC because it has like the least amount of regulation, but it also provides you with a decent layer of separation and protection. So it's kind of that like it's a good stepping stone that you might never have to step above. Does that make sense? Doesn't matter. So financial setup, LLC, profits passed to members according to the operating agreement. So like, let's say you and your friend that started the gallery, now you have an LLC. And you say, okay, 60% of the profits go to me, 35% go to you, and 5% goes to that limited partner over there. Now that's in an operating agreement with your LLC. Profits are taxed once as personal income tax. You hear this referred to as a pass-through income. This is the most common way that's done with LLCs. There is a way to be an employee of your LLC, but we're going to get into that with the employment unit. For now, think of it this way. The money hits the LLC, doesn't get the corporate tax applied, goes straight to you as personal income. So in addition to loans, personal gifts, and personal capital, now LLCs, you can sell a percentage of the company. This is not common stock, which we'll talk about later. But think of the show Shark Tank. The sharks are investing. They're saying like, I'll give you $300,000 for 20% of your company. You have to have an LLC in order to do that. You can't divide up a sole proprietorship. You can't divide up a partnership. You have to have an LLC or some kind of incorporation to legally sell off portions of a company, sell off ownership. I forgot to mention that during the partnership part where I talk about limited partners. You do have to have some incorporation there. Ownership, one or more people can own it, which is great. Percentage of ownership is spelled out in incorporation. Transfer of ownership to others is possible. So talking about sole proprietorship, you can't like You have to sell the business to someone else. You can't just, because you can't give away yourself. Now it's separated. So if I have Tom Hughes LLC and I don't want to do it anymore, I can transfer the ownership of Tom Hughes LLC to my brother Kenny. And then Kenny owns the company. It's still called Tom Hughes LLC, has the same brand, does the same stuff, it's all the same, but Kenny owns it. So you can transfer ownership to other people. And then risk. Finally, risk is limited. With an LLC, personal assets are considered separate from business assets. So if you get sued, they can't go after things like your house or car. LLCs are popular business structures because of the protections and flexibility that they offer. If you're going to get into something that's a little bit more risky, involve a lot of money, involve a lot of business activity, it's a good idea to form an LLC. It's a base level of incorporation. And there's all different types along this limited liability thing. There are limited liability partnerships. There are limited family limited liability partnerships. There's all different types. Control. Decisions are made by the owners or appointed members. Appointed members are things like employees. And decision-making and management will be best defined by an operating agreement. You don't need to have an operating agreement necessarily to form an LLC, depending on state to state. You absolutely should have an operating agreement. Click this link to see what an operating agreement is. It spells out the rule of how you operate. Establishment. Last element of force. You must file articles of incorporation with the state government in which your business resides. The rules are different from state to state. LLCs. Love them. All right, S corporations. So an S corporation, sometimes called an S corp, it's a special type of corporation that's designed to avoid the double taxation drawback of regular C corps. A lot of this is not going to make sense until we get through C corps. So S corps allow profits and some losses to be passed through directly to owners' personal income without being the subject to corporate tax rates. So here's the idea. If you want more protection, you want more advantage of a big corporation, but you don't want to be taxed like a big corporation. You want to be taxed like your LLC. You want it to pass through to you. There's this thing in the middle called an S corp. And again, we're going to roll through this. This will make more sense when we get to C corps. So financial setup. You're taxed once as opposed to a C corp. Tax responsibility passes to individual owners, very much the same as the past things we've talked about. Individuals pay income tax, and this is an important one. An S corp, you can sell up to 100 shares of owner's equity. So you can have 100 different people involved in your company as shareholders. This is really popular. So there are things like an employee-owned business. Say you want to run a business where the employees own the business. That is a lot of times they're formed as S corps. So if your business has like 70, 80 people in it, you form an S corp, it's 70 or 80 shares of the profits. Also, transfer of ownership is possible. So employee-owned company, someone quits, they have to transfer the ownership back, and that ownership can be transferred to the new employee. Risk. Risk is more limited than an LLC. I mean that in a positive way. You're much less open to liability and risk. The corporation is even more separate than in the LLC. Personal assets are separate from business assets. That's a positive. Remember that. S corps are popular investors because there's more protection. Control, board members and appointed officers. There's a little bit of a new concept here. Now we're talking about, so you might have an employee-owned company. So there's maybe 100 people that own the company, but there's 3 people in charge. According to the operating agreement, there are 3 board members. There might be like a CEO, chief executive officer, CFO, et cetera, et cetera. Those are the different people in charge. To establish it, you have to file articles of incorporation and bylaws with your state government. Essentially the same as a C corp with some exceptions. And then you have to additionally file this thing called Article S with the IRS. That's why it's called an S corp, because it's Article S of the tax code. C corporations. Second to last one. We're almost there. We're at 50 minutes, so I need to wrap this up quick. C corporation. Corporation, sometimes called a C corp, is a legal entity that's separate from its owners. Corporations can make a profit, be taxed, and can be held legally liable. This is the most limited in terms of liability. C corps are completely separate from the people that run them. Financial setup. Profits are taxed twice. This is the biggest drawback of a C Corp. You have to pay corporate taxes, and then after the corporate taxes, when you get your profits, then you have to pay personal income taxes on that. This is the two-tax structure that things like LLCs and S Corps can avoid. It's just part of doing business. If you want to be a C Corp, you're going to get taxed twice. This is also why you hear a ton of people talk about the idea of trying to lower corporate taxes to maximize profits. Some corporations don't even pay corporate taxes. How? I don't know. They have really good lawyers. So in addition to loans, startup capital investments, C corporations can sell limited ownership in the company through the issuance of common stock. So think of like the stock market. You can buy shares in Apple. You are buying little pieces of ownership in the company, and that's how they're able to raise money. The stock market is basically a huge way to raise money. Ownership. One or more people can own it. Initial percentages of ownership are spelled out at incorporation. Transfer of ownership to others is possible. An additional limited ownership can be added through the selling of common stock. Risk. Again, personal assets are considered separate, but C Corps are popular because risk is the most limited. C Corps are the most separate from the owners. Something goes wrong, there's very low likelihood you're going to be held responsible. Not zero, but low likelihood. Control. Board members and appointed officers have control. We see this in movies all the time when the guys get together in the boardroom. Sorry, I said guys because I was thinking of like traditional shit, patriarchy. Just like white dudes in suits at a board table. You see it in movies all the time. Board members are spelled out by articles of incorporation and corporate bylaws. Depending on the industry, there are a lot of state and federal regulations to follow. It's an important thing to know if you're going to start a C Corp and work in like the energy sector. Establishment. You must file articles of incorporation with your state government in the business in the state in which your business resides. Fun fact, the most incorporations in the US are in Delaware because they have the lowest corporate tax rate. Or I think they do. But that's why Delaware has, so it's like, you know, a company might be all throughout the US, but they're located in Delaware. Additionally, you must create corporate bylaws, rules of the corporation. While not required, it's almost impossible to run a C Corp without bylaws. You need to have the bylaws. And then finally, of incorporation, we end up with not-for-profit organizations. My gift did not work, and I'm very angry about that. So what is a nonprofit corporation? Nonprofit corporations are organized to do charity, education, religious, literary, or scientific work. Because the work benefits the public, nonprofits can receive tax-exempt status, meaning they don't pay state or federal taxes on any of the profits it makes. Let's go through force. Financial setup. Because of the charitable mission, nonprofits do not pay income tax. You have to pay income tax if you're an employee. Remember that double tax structure I talked about? They don't really have to pay corporate taxes. I might have misstated that, but we're just going to move on. Additionally, when someone makes a charitable gift to a nonprofit, it is considered a gift, not an investment. Gifts do not grant ownership the way an investment or stock purchase does. If I give $100 to Raices, which is a nonprofit that works with immigrants at the border, I don't buy $100 of ownership in Raices. I'm giving them a gift. I don't get ownership. And there are no profits. That's why they're nonprofit. Nonprofits make money. It's a misnomer when people say, oh, they're nonprofit. They don't know how to make any money. They make money. The point is they don't profit from that money. The money has to go back into the organization to pay for programs and salaries. All of the profit they make gets pumped back into the organization. That is the key point about a nonprofit organization. So, ownership, next part of force. It's technically not owned in the traditional sense. Nonprofits are considered public charities and are intended to have lives beyond their founders. This is important to remember. When you form a nonprofit, you are surrendering ownership to the corporate entity. Remember, it's separate from you. You are surrendering ownership. Risk. Personal and business assets are separate. Very low personal risk. This is why a lot of creative practices choose to form nonprofits. This isn't always the best way to go forward, but it's just an idea behind. It's just an example of which. So when we think about like big nonprofits, think about things like museums, theaters, galleries. A lot of those are nonprofits to reduce risk, but also to get those sweet tax deductible gifts. Control. One or more appointed officers and a board of directors for oversight. All nonprofits have a board. They're responsible for the general governance of an organization. That basically means that the nonprofit has to adhere to the bylaws it sets forth. Boards don't do the day-to-day management. They're more there to make sure the nonprofit is staying on track. Also with nonprofits, there's a ton of rules and regulations to follow. Nonprofit statuses can be rescinded if the organization does not adhere to legal guidelines. You can have that status taken away. It's not good to have it taken away. Really bad shit happens if it's taken away. Establishment, you need a minimum of 3 board members, just 3, to form a nonprofit. File the article of incorporation and bylaws with the state government, and additional filing with the Internal Revenue Service. This is the only one that you have to do an additional filing with the federal government. Whew, we made it through. So to wrap up, we're going to talk about some other considerations. Looks like we have about 4 minutes left. I promised this would only be an hour, so let's roll right into it. Other considerations. Business licenses. If your business involves something that's regulated by the government, you're going to need some kind of license. So it's like, let's say you're doing radio and television broadcasting, you have to file something with the Federal Communications Commission. Let's say it's a sale of alcohol, you have to go with like a local liquor board, for instance. If you're going to conduct an auction, do construction, if you're going to do retail sales, a lot of times you need these additional licenses. Sometimes they come from the federal government, sometimes they come from the state government. How do you get a business license? You submit an application through the agency that oversees the regulation. Some licenses are only for a limited period of time. Maybe they're only for a year and you have to renew them. And there's usually a fee. Sometimes the fees can be tens of thousands of dollars. So it's important to do your research. Every township, city, state has a chamber of commerce. It's a good place to look up what kind of licenses you need. Also, literally, there's the professional association for every type of business that exists. And if you reach out to them, they can usually help you out. Another consideration, changing a structure. So you can change the structures to suit growth or the changing needs of a business. How would you change a structure? Let's say you want to go from an LLC to an S Corp. You need to update your operating agreement and you have to reincorporate through that state government. But I want to make it clear that major changes, like going from a C Corp to a nonprofit or like an LLC, there are more controls put in place by state and federal government. There's a lot of regulations. It's designed to prevent fraud. But the thing is, you don't have to pick a structure and be stuck with that structure forever. There are ways to change and adjust. Some are more cumbersome than others, but the real point here is that it can change. And then temporary or single purpose businesses. Not everything needs to last forever. Well, let's start with a single purpose. Let's say you have let's say you want to buy a property and turn it into artist residencies, but you don't want to buy that property and take a lot of the personal liability on, but you still want to run it as a sole proprietorship. Well, what can you do? You could form an LLC that's only purpose is to own that property. It's very common in real estate, but it's becoming more prevalent in creative practices because you can have an LLC that owns a movie that you made, that owns more of a complex piece of software that you made. It provides that layer of separation and protection, but it's also limited. It does one thing. Also, the idea of a temporary business. When I was talking earlier about the costume designer working for a limited run TV series at the top of the lecture, that's an example where, you need costume assistants, dressers, asset managers. The production company might want you to build out a team. So in this case, you could form a temporary LLC, one that expires when the film is complete. So it's extremely common with performing arts. It gives you the ability to team up and share profits, but also limit that liability. And then here, just to wrap up, we have some additional structures. These are things I did not even get into that are available to you. You can click through and read all these. They're common, but not as common as the ones that I've covered. I've also linked to some good resources here about choosing business structures, and I've made comparison tables for you that goes through all of FORCE. So things like financial setup, it goes through the financial setups for each of the different ones. So you can compare and contrast. Again, this is all on the website. This will be at the top of the page of business formation. And all right, let's see if I can end this perfectly on the hour. And see you later.